Hello everyone. Thanks for joining in on Saturday. Today we are going to start with final thoughts on cash flow practice, and then we will move on to property, plant and equipment. I have a bit of a cold today, so my voice might sound different. Also, let me know if there are any issues with the picture or with the sound. Let me just double check real quick that we are not having issues. I will listen to myself just in case. Okay, sounds okay for me. Final reminders to the chats. And let's begin. Okay. So during this week we did a lot of theory and practice on cash flow statements. For those who missed it, we started by looking at some real cash flow statements. Let's see what we have here. AMC statement of cash flows. So every company which reports its financial information publicly includes cash flow statement into its recording package. It's a requirement. It's a reporting requirement. And cash flow statement is as important as income statement, because there might be situations when you reported income is dramatically different from your cash flows, and your banks and shareholders they mostly care about cash flows, at least if it is an established company, not some kind of a startup or newly IPO'd company. And we reviewed an example of AMC where they had net loss of 3.6 billion. That's for 9 months 2020, but their actual operating cash outflow was like 800 million. And all of that happened because they had a lot of non-cash items in their income statement, mostly an impairment of long-lived assets. As we can see, like in AMC case or in Apple case, let me open Apple real quick. Financial statements and supplementary data. Cash flow. As we can see, cash flow statements consist of 3 parts. It has cash generated by operating activities, cash generated by used in investing activities, and cash used in financing activities. And the definitions for these 3 activities you can easily find in the guidance. Let's see. I have the guidance here. It's a PwC guidance. We use it a lot for these lectures. They have classification of cash flows, page 112. So they basically define investing activities as those activities which include making and collecting loans, purchasing and selling debt or equity of other reporting entities, and acquiring and disposing property, plant and equipment and other productive assets used in the production of goods and services. So basically, investing activities is whatever you invest in loans you issue to someone, and later you will collect the principal. It will also be an investing activity. Purchase and selling debt or equity instruments of other reporting entities. So you do not include repurchase of your own shares in investing activities. And your investments in CapEx in your own property, plant, and equipment. And you need to remember, if you, for example, you have a construction company or equipment manufacturing company which manufacture and sells some buildings or equipment, this will be your operating activity. This will not be your investing activity. Investing activity will be only assets which you use to produce your own goods or services. So that's investing activity. Financing activity includes borrowing money and repaying or settling the obligation and obtaining equity from owners and providing owners with a return on or return of their investments. So basically, financing activity is operation with your creditors, whoever gives you money, banks, if you sell your bonds, purchasers of your bonds, and with your shareholders. So that's a financing activity. And operating activity is whatever is left after all of that. During previous lectures, we did a bit more of digging around that, so you can review the previous lectures. Okay, and we see that Apple is doing quite good. Operating cash flow, $100 million. Investing activities, $14 million. And what else do we have here? Financing activities, $93 million outflow, and most of the outflow is for repurchases of common stock. So they buy back their own stock, and they used $85 billion for that. They also paid dividends. So you see, financing activities is whatever operations you have with your creditors or with your owners of your company, your shareholders. Now the guidance, the accounting standards give us actually two options to report. One is direct cash flow method, and the other one is indirect cash flow method. As a part of our homework, let's see. So we did one cash flow with direct method. The investing and financing activities will look the same under both methods, but operating activities will look different. Under direct method, you will try to show every cash flow by its nature. So for example, you paid some amount of money to suppliers during the year, and you will try to come up with that amount and show it in the operating cash flows. You collected some cash from customers, and you will also show that in your cash flow statement. You'll pay some interest on your borrowings, and you will also show that in your statement. And most companies do not use that method because, first of all, it's pretty hard to calculate these numbers. Most of the time, you will have to have like a transaction list, and you will need to classify each transactions to come up with these numbers. Or for example, your accounting system might be set up in a way to be able to calculate that. But if you come to a situation of consolidating of several different companies, that task becomes mostly impossible. So you will have quite a bit of exercise to come up with direct method operating cash flows. We also tried here to experiment and try to come up with the same numbers by using aggregating numbers. So if you have a complex company, complex consolidation, your best available information is usually like trial balance level. So you have all the aggregated data in the trial balance, but you don't have access to every company. You don't have access to every company transaction detail. So we tried to come up. Revenue was relatively simple, but when we go to cash paid to suppliers, we realize that we have to deal with accounts payable to suppliers, inventory movements, other purchases, and it all complicates our calculations quite a bit. And the second reason why no one likes direct cash flow method, you are also required, when you calculated your direct cash flow method and got your operating cash flow number, you are also required to reconcile that operating cash flow number back to net income. And that reconciliation in itself, it is what you do when you prepare your operating cash flow indirectly. So for indirect method, and as you remember, AMC and Apple and most of the other publicly trading companies, they use indirect method for operating cash flows. And in indirect method, you start with net income and you adjust net income for different non-cash activities like depreciation, bad debt expense, inventory provisions. Then you have some kind of reclasses related to non-operating cash flows, related to investing activities and financing activities. You also have some non-cash items. Then you adjust all of that to your changes in working capital, in your trade receivables, inventories, other assets, operating accounts payable. So all of these, if you sell most of your stuff during the year and you only got accounts receivable, so you didn't collected cash, you'll be in a situation when you sold, when you earned some income, but you haven't generated any cash flows. So any increase in trade receivables will adjust your net income and will decrease your operating cash flows. And the opposite works for accounts payable. Any increase in accounts payable is kind of improves your cash flows, and inventories are the same as receivables. So if you increase inventories during the year, it's a cash outflow. Okay. And we also, to be able to say that we come up with all our items here, we used our direct method as a reconciliation point. We also did an exercise to come up with PP&D numbers indirectly, and we started. We did like a roll forwards. So we did roll forward on costs, net book value, accumulated depreciation, and we figure out what cash did we pay for PP&D. And to do so, if we start with cost, and if we did any disposals of fixed assets here, we need to have a disposal number, and usually that is not what's available from your trial balance. In trial balance, by default, you have, let me see, no, not course related. In trial balance, you usually have gain or loss on disposal of assets, and you don't have breakdown by You don't have breakdown by cost of assets and proceeds from assets. So you need to think ahead, how will you come up with that number? And then you can figure out the cash paid for PP&D based on your closing PP&D and based on your non-cash acquisition of PP&D. You also need to think about non-cash acquisition of PP&D, because in some cases, when you got a financial lease on PP&D, or if you got a seller financing on PP&D, you will not show that in your investing cash outflows or in your financing cash inflows. You will show it into the non-cash investing and financing activities. So like if you buy something on the financing lease, it will not show up as a property acquisition in investing, and it will not show up as a new loan in financing. If it's a financial lease, it will show up in the notes to the statements. And if we go to AMC, we will see that they have quite a bit of stuff related to non-cash activities. Investments, construction payments, so quite a bit of interesting stuff. Sorry, I will take a second. Okay, I am back. So that's what pitfalls you might face in the cash flow statement. Let's list what we came up with. Indirect. So indirect is usually easier to do than direct, because when you do direct method, you do direct method first and you also do then indirect method. It doesn't make any sense, but that's how standard requires you to do that. Okay, so next, bad debt provision. Reflect only current year prior year in changes so that's also might sound complicated, but if you got some opening accounts receivable provision, and then you were able to recover money from that provision, and then you accrued new provision in your cash flow, non-cash movement, you will only show current year bad debt new provisions, and same stays for inventory. And it might be difficult, it might be different under IFRS. Check. Okay, and we are reviewing only like basic stuff, which even small businesses can face it. Most small businesses do not report under IFRS or GAAP. They kind of report mostly for internal purposes or for taxation, and they are not audited, so it might be not a big deal for them. Okay, then non-cash acquisition of PP&D. It's leases and seller financing. Then disposals, let's call it dealing with disposals of fixed to calculate investing cash flows and adjustment to okay. As a reminder, here is a link to financial statement preparation guide. We did quite a bit of scrolling around it. It has a full chapter about cash flows. The most useful thing which you probably will use the most is the sample statement of cash flows. Sorry. It has all the headers, all the captions. Not all, but quite a few. And you can find what if you have some cash flow which you want to classify, you can find some caption here. And we also have some supplemental cash flow information. Let's also mention it here. Where we have it. Okay, and the last thing related to homework. So our homework 5 was about building a cash flow statements, which we have been doing all this week. We reflected these transactions as well in our transaction list. And we still have our revenue recognition accounting memo. And I just wanted to conclude on that part. Let's see where we stopped. So we were doing allocation for identify performance obligations, and we needed to identify separate performance obligations in the contract. And we ended up saying that half of our setup fee is not SPO, another half is SPO, and subscription and support services are SPO. And what I wanted to add here is that depending on the circumstances, you might be able to combine support services and subscription into one. Okay, so that is all for practice today. Over the next couple of weeks we will go into transaction price exercise and allocation exercise. I just wanted to remind you where we stopped, so we will finish that exercise, and we will try to find quite a few more pitfalls in the revenue recognition. Okay, now we will have a 5-minute break, and we will start with PP&D. Let me share the link to the next. Okay, homework tip. Let's see if it will fit into YouTube comment. No. Okay. Okay, link is here. Thanks everyone for coming. Let me open. As you remember, the work we do it through the schedule. And all links I put all links to the schedule, so all new information is here, and we also have links to MIT lectures in here. Okay. Okay. Thanks everyone for coming. You can now switch to the next lecture.